Hello everyone, welcome to the 61st episode of me learning how to trade in Forex. So in the last episode we went through the exponential moving average, explained. We just learned about what it is. We learned that the exponential moving average is closer to the actual real market price than the blue line, which is the simple moving average, because the exponential moving average places more emphasis on what has been happening lately, whereas the simple moving average, I guess, is like everyone has the same equal rank, if that makes sense. So it's not really leaning towards what's been happening recently. So in this episode we're going to be doing simple versus exponential moving averages, and yeah, let's get started. So layout below, simple versus exponential moving averages, 1st of March 2024. Alright, by now you're probably asking yourself which is better, the simple or the exponential moving average. First, let's start with the exponential moving average. When you want a moving average that will respond to the price action rather quickly, then a short period exponential moving average is the best way to go. So, short period exponential moving average, best for responding, best moving average for responding to the price action quickly. These can help you catch trends very early, more on this later, as it helps you catch trends early, which will result in high profit. In fact, the earlier you catch a trend, the longer you can ride it and rake in those profits. Booyah! The earlier you catch a trend, the longer you can ride it and rake in those profits. Yep. The downside to using the exponential moving average is that you might get faked out during consolidation periods. Oh no. Because the moving average responds so quickly to the price, you might think a trend is forming when it could just be a price spike. This would be a case of the indicator being too fast for your own good. So, however, fake outs could happen during consolidation periods could happen. As price spikes could occur, which the moving average would think it's a trend. With a simple moving average, the opposite is true. When you want a moving average that is smoother and slower to respond to price action, then a longer period simple moving average is the best way to go. So long period simple moving average, best moving average for responding to the price action slowly as it slowly and smoothly. This would work well when looking at longer time frames. when looking at longer time frames. As it could give you an idea of the overall trend. Giving you the overall trend. This will work well when looking at longer time frames, as it could give you an idea of the overall trend. Yep. Although it is slow to respond to the price action, it could possibly save you from many fake outs. Slow meaning won't be affected that much by fake outs. The downside is that it might delay you too long, and you might miss out on a good entry price or the trade altogether. However, the moving average may delay you for too long, and you might miss out on a good entry price or the trade altogether. An easy analogy to remember the difference between the two is to think of a hare and a tortoise. So the hare is the exponential, the tortoise the simple. Tortoise is slow like the simple moving average, so you might miss out on getting in and trend early. However, it has a hard shell to protect itself, and similarly, using the simple moving average would help you avoid getting caught up in fake outs. On the other hand, the hare is quick, like the exponential moving average, helps you catch the beginning of the trend, but you run the risk of getting sidetracked by fake outs or naps if you're a sleepy trader. Below is a table to help you remember the pros and cons of each. So, pros of simple moving average: displays a smooth chart that eliminates most fake outs. Cons of simple moving average: slow moving, which may cause a lag in buying and selling signals. For the exponential moving average, the pros: quickly moving and is good at showing recent price swings. Cons: more prone to cause fake outs and give errant signals. When to use simple moving average versus exponential moving average. So which one is better? With moving averages in general, the longer the time period, the slower it is to react to price movement. With moving averages, the longer the time period, the slower it is to react to price movement. But with all else being equal, an exponential moving average will track price more closely than the simple moving average. With everything equal, exponential moving average tracks price more closely than a simple moving average. Because of this, the exponential moving average is typically considered more appropriate for short-term trading. Exponential moving average is more appropriate for short-term trading. The same attribute that makes the exponential moving average more suited for short-term trading limits its effectiveness when it comes to longer-term trading. Since the exponential moving average will move with prices sooner than the simple moving average, it often gets whipsawed, making it less than ideal for triggering entries and exits on slower chart timeframes like daily or longer. The simple moving average, with its slower lag, tends to smooth out price action over time, making it a good trend indicator. So simple moving average smoothes price action out over time, meaning it's a good trend indicator. allowing it to remain long when the price is above the short moving average, simple moving average, and short when the price is below the simple moving average. So, simple moving average or exponential moving average. It's really up to you to decide. You don't have to limit yourself to a single type of moving average or a single instance of a moving average. Many traders plot several different moving averages to give them both sides of the story. They might use a longer period simple moving average to find out what the overall trend is, and then use a shorter period exponential moving average to find a good time to enter a trade. So, can use a combination of moving averages, i.e. use both longer period of simple moving average and shorter period of exponential moving average. So longer period of exponential moving average, was it longer periods to see the overall trend, use long both, so you can see the trend in the long term, but also know how to enter trades in the short term. Right? Overall trend is to find a good time to enter a trade. Yep. There are a number of trading strategies that are built around the use of moving averages. In the following lessons we will teach you how to use moving averages to determine the trend, how to use multiple moving averages together, how moving averages can be used as a dynamic support and resistance. Time for recess. Go find a chart and start playing some with some moving averages. Try out different types and try experimenting with different periods. In time you'll find out which moving average works best for you. Okay, so how to use moving averages to find a trend. How to use moving averages to find the trend. One sweet way to using moving averages is to help you determine the trend. The simplest way is to just plot a single moving average on the chart. When price action tends to stay above the moving average, it signals that price is in a general uptrend. If price action tends to stay below the moving average, then it indicates that it's in a downtrend. Right, okay. Moving averages can help determine the trend. Plot a single moving average on a graph. When price action tends to stay above the moving average, it signals that the price is in a uptrend, right? In a general uptrend. When price action tends to stay below the moving average, it signals that the price is in a general downtrend. Yep. Stay below the moving average, downtrend, yep. Price is above the moving average, time to buy. So this is above, so pretty much most of it is above, so buy. The problem with this is that it's too simplistic. Okay, never mind. Let's say that USD JPY has been in a downtrend, but a news report comes out causing it to surge higher. Looks like a change in the trend, time to buy? No. This is only one of it, isn't it? We have to look at the rest, because it might continue to go down. You see that price is now above the moving average, you think to yourself, it looks like this pair is about to shift direction, time to buy this sucker. So you do that, you buy 1 billion units because you're confident that USD JPY is going to go up. Down, down. It was a fake out. The downtrend continues. Bam, you get faked out. As it turns out, traders just reacted to the news, but the trend continued and the price kept heading lower. What some traders do, and what we suggest you do as well, is that they plot a couple of moving averages on their charts instead of just one. Plot more than one moving averages. On the chart. This gives them a clearer signal of whether the pair is trending up or down depending on the order of the moving averages. Let us explain. In an uptrend, the faster moving average should be above the slower moving average, and for a downtrend, vice versa. Right, okay, so if there's more than one moving averages on the chart, in an uptrend, the faster moving average, so like the exponential one, should be above the slower moving average, so aka a simple moving average. But then fast and slow in this case could also mean faster is like a shorter time period, whereas slower could be like a longer time period one as well. So moving average in a downtrend, the faster moving average should be below the slower moving average. For example, let's say we have two moving averages, the 10 period moving average and the 20 period moving average. On your chart it will look like this. Notice how the 10 period simple moving average is above the 20 period simple moving average throughout the uptrend, because it's shorter period, so it's faster, so it's above. Yeah. Above is the daily chart of the USD JPY. Throughout the uptrend, the 10 simple moving average is above the 20 simple moving average. As you can see, you can use moving averages to help show whether a pair is trending up or down. By combining this with your knowledge of trend lines, this can help you decide whether to go long or short a currency pair. You can also try putting more than two moving averages on your chart. Just as long as lines are in order, faster moving average over slow moving average in an uptrend, slower moving average over faster moving average in the downtrend, then you can tell whether the pair is an uptrend or a downtrend. Okay, how to use moving average crossovers to enter trades. So, how to use moving average crossovers to enter trades. 01/03/2024. So far you have learned how to determine the trend by plotting some moving averages on your charts. You should also know that moving averages can help you determine when a trend is about to end and reverse. So moving averages can help determine when a trade is about to end and reverse. As trend traders, you want to recognize and ride the trend for as long as possible. You have to know when to get in and when to get out. A trend can be definitely defined simply as the general direction of the price over the short, intermediate or long term. Some trends are short-lived while others last for days, weeks or even months. But you don't necessarily know how long a specific trend will last. A technical tool known as the moving average crossover can help you identify when to get in and out. Average crossovers can help determine when the trade is about to end and reverse. Oh no. Moving average can help you determine when a trade. Moving average crossovers can help determine oh no, when to get in and out of the trend. A moving average crossover occurs when two different moving average lines cross over one another. So moving average crossover occurs when two different moving average lines cross over each other. Okay. Because moving averages are a lagging indicator, the crossover technique may not capture exact tops and bottoms, but it can help you identify the bulk of a trend. A moving average crossover system helps to answer these three questions. Which direction might the price be trending, if at all? Where might be the potential entry point for a trend trade? Where might a trend be ending or reversing? All you have to do is plop on a couple of moving averages on your chart and wait for a crossover. If the moving averages cross over one another, it could signal that a trend is about to change soon. If averages cross over each other, it could signal that the trend is about to change soon, thereby giving you the chance to get a better entry. By having a better entry, you have the chance to bag more pips. If Allen Iverson made a living by having a killer crossover move, why can't you? Let's take another look at the daily chart of USD JPY to help explain moving average crossover trading. So got the uptrend, this is where the crossover, so you got the 10 simple moving average is the blue, the, what's it called, orange is the 20 simple moving average, crossover here, so now the 20 simple moving average is above the 10 simple moving average. Notice how after the crossover the pair began a nice downtrend. From around April to July, the pair was in a nice uptrend. It topped out at around 12400 before slowly heading down. In the middle of July, we see that the 10 simple moving average crossed below the 20 simple moving average. And what happens next? A nice downtrend. If you had shorted at the crossover of the moving averages, you would have made yourself almost 1,000 pips. Of course, not every trade will be a 1,000 pip winner, a 100 pip winner, or even a 10 pip winner. It could be a loser, which means you have to consider things like where to place your stop loss or when to take profits. You can't just jump in without a plan. What some traders do is that they close out their position once a new crossover has been made, or once the price has moved against the position at a predetermined amount of pips. What some traders do is that they close out their position once a new crossover has been made, or once the price has moved against the position a predetermined amount of pips. This is what Huck does in her HLHB system. She either exits when a new crossover has been made, but also has a 150 pip stop loss just in case. The reason for this is that you just don't know when the next crossover will be. You might end up hurting yourself if you wait too long. One thing to take note of with crossover system is that whilst they work beautifully in a volatile and or trend environment, they don't work so well when price is ranging. So crossover works well in a trending environment, but not in a ranging environment. So ranging is the one that goes like across horizontally. You get hit with tons of crossover signals and you could find yourself getting stopped up multiple times before you catch a trend again. In summary, moving average crossovers are helpful in identifying when a trend might be emerging or when a trend might be ending. The crossover system offers specific triggers for potential entry and exit points. These triggers should be confirmed with a charts pattern or support and resistance breakouts, which you'll learn about later in the school. So the potential entry and exit points are where these two moving averages cross over at. Okay, so how to use moving averages as dynamic support and resistance levels. Another way to use moving averages is to use them as dynamic support and resistance levels. Moving averages can be used as dynamic support and resistance levels. We like to call it dynamic because it's not like your traditional horizontal support resistance lines. They are constantly changing depending on the recent price action. Dynamic support and resistance levels constantly change depending on the recent price action. There are many Forex traders out there who look at these moving averages as key support or resistance. These traders will buy when the price dips and tests the moving averages and tests the moving average, or sell if the price rises and touches the moving average. Let's take a look at the 15-minute chart of GBP/USD and pop on the 50 exponential moving average. Let's see if it serves as dynamic support or resistance. British pound versus the US dollar, 50 exponential moving average. Price bounced off the exponential moving average each time. So boing, 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 boing. It looks like it held really well. Every time price approached the 50 exponential moving average and tested it, it acted as a resistance and the price bounced back down. Amazing, huh? One thing you should keep in mind is that these are just like your normal support resistance lines. This means that price won't always bounce perfectly from the moving average. Sometimes it will go past it a little bit before heading back in the direction of the trend, but act just like normal support and resistance levels. There are also times when the price would blast past it altogether. What some forex traders do is that they pop on two moving averages and only buy or sell once the price is in the middle of the space between the two moving averages. You could call this area the zone. Let's take another look at the 15-minute chart of GBP/USD. But this time let's use the 10 and 20 exponential moving averages. Price dropped every time it entered the zone. Right, so the zone is the area between two moving averages. From the chart above, you can see that the price went slightly past the 10 exponential moving average a few pips, but proceeded to drop afterwards. There are some traders who use intraday strategies just like this. The idea is that just like your horizontal support resistance areas, these moving averages should be treated as like zones or areas of interest. The area between moving averages could be considered as a zone of support or resistance. Breaking through dynamic support and resistance. Now you know that moving averages can potentially act as support resistance. Combining a couple of them, you can have yourself a nice little zone. But you should also know that they can break just like any support resistance level. Let's take another look at the 50 exponential moving average and on GBP/USD's 15-minute chart. Dynamic support and resistance levels can be broken just like normal support and resistance levels. Let's take another look at the 50 exponential moving average on GBP/USD's 15-minute chart. So resistance here, bounces back in and turn to support, broken past the exponential moving average. Yeah. In the chart above, we can see that the 50 exponential moving average held as a strong resistance level for a while, as GBPUSD repeatedly bounced off it. However, as we've highlighted with the red box, the price finally broke through and shot up. Price then retraced and tested the 50 exponential moving average again, which proved to be a strong support level. So there you have it, folks. I can't say that word for some reason, folks. Moving averages can also act as dynamic support resistance levels. One nice thing about using moving averages is that they're always changing, which means that you can just leave it on your chart and don't have to keep looking back in time to spot potential support or resistance levels. You know that the line most likely represents a moving area of interest. The only problem, of course, is figuring out which moving average to use. How to use moving average envelopes. Moving average envelopes. So, what are moving average envelopes? Let's rewind and briefly talk about moving averages first. The goal of using moving averages is to identify trend changes. Whilst moving average are a useful tool to have in your technical analysis toolbox, they can be susceptible to providing false signals. Like you've learnt in the previous lessons on moving averages, a simple buy signal occurs when price closes above the moving average, and a simple sell signal occurs when the price closes below the moving average. For example, let's say that Euro USD is moving upward and closes, actually, let's just say, moving averages, identify trends, trend changes. Averages are susceptible to providing false signals. Buy when price close above the moving average. Sell when price close below the moving average. For example, let's say EUR USD is moving upwards and closes above a moving average, signaling an entry to go long. How do you know that this bullish trend is real and will continue? You don't. So assuming you still want to go long, you have two options. Go long now based on the original entry signal, price closed above the moving average. Wait for more confirmation that trend is legit. This is where moving average envelopes can help. Moving average envelopes like this? No, not that kind of envelopes. What are moving average envelopes? A moving average envelope consists of a moving average and two other lines. Moving average envelope consists of a moving average and two other lines. One line is above the moving average and the other is below the moving average. Line is above the moving average. One line is below the moving. Together, these two lines form an upper and lower envelope, forming an upper and lower envelope. It's called an envelope now because these two lines envelop the original moving average line. Upper envelope, moving average, lower envelope. Moving averages envelopes are used to confirm trends, identify overbought and oversold conditions. Moving average envelopes are used to confirm trends and identify overbought and oversold conditions. How to calculate moving average envelopes. How to calculate a moving average envelope is pretty simple. First, decide whether you want to use a simple moving average or exponential moving average. Remember, exponential moving averages have less lag because they put more weight on recent prices. Then select the number of time periods you wish to apply. Lastly, set the percentage value you'd like to use for the envelopes. For example, a 10-day moving average with a 1% envelope will show the following lines. So upper envelope is 10-day simple moving average plus 10-day simple moving average times 0.1. Lower envelope would be 10-day simple moving average minus 10-day simple moving average times 0.1. 0.01, sorry. Both are 0.01s. The chart below shows Euro USD with a 10-day simple moving average and 1% envelopes. Notice how the envelopes, the blue lines, move parallel with the 10-day simple moving average, which is the orange line. They remain a constant 1% above and below the moving average, orange line. How to confirm trend direction of moving average envelopes. Since the foundation of moving average envelopes is the moving average, this means that the moving average envelopes can be used as the trend following indicator. The direction of the moving average determines the direction of the envelopes. Direction of the moving average determines the direction of the envelopes. When the envelopes are moving higher, the price is in uptrend. When the envelopes are moving lower, the price is in a downtrend. Envelope moving higher equals uptrend. Envelope moving lower equals downtrend. When envelopes are moving sideways, the price is neither in uptrend or downtrend. The trend is neutral and the price is considered directionless. Envelope moving sideways equals no trend. You should pay attention when the price moves above or below the envelope. Pay attention when price moves above or below the envelopes. Since trades often begin with a strong move, if the price surges above the upper envelope, this is considered bullish. If price goes above the upper envelope, it's bullish. If price goes below the lower envelope, it's bearish. Buy signal. If the price closes above the upper envelope, buy. Buy when the price closes above the upper envelope. Sell when the price closes below the lower envelope. Example, GBP/USD. In the chart below, notice how the 20-day simple moving average, orange line, and the upper and lower envelopes, blue lines, are moving higher. Yep, so they're going like that. Price closed above the upper envelope, price closed above the 20 simple moving average. See how the price managed to close above the moving average? To confirm that the trend has changed from bearish to bullish, you could wait until the price has also closed above the upper envelope. How to identify overbought and oversold levels of moving average envelopes. There will also be times when the price initially moves above or below the envelope, but turns back around. This usually happens when the moving average slope is flat. When this happens, moving average envelopes can be used to identify overbought and oversold levels. When the price moves above the upper envelope, this can be considered overbought. Price goes above the upper envelope, it's overbought. When price goes below the lower envelope, it's oversold. Identifying overbought and oversold levels isn't easy though. Remember, a currency pair can become overbought and remain overbought when the bullish trend is strong. The same goes for the being oversold. In a strong bearish trend, something can be technically oversold but remain oversold for quite some time. This is why it's best to pay attention to the slope of the moving average and make sure it's flat. If the moving average slope is flat, or when price initially moves above or below an envelope, but turns back around, the moving average envelopes can be used to identify overbought and oversold levels. It's flat. Yep. You should confirm overbought and oversold levels with support and resistance levels. This should be confirmed with support and resistance levels. Buy signal. If price touches or falls below the low envelope, then rises back above buy. If price touches or falls beneath the lower envelope, then rises back above buy. If price touches or falls above the upper envelope, then falls back below, sell. If prices touches or rises, or not falls, rises. If the price touches or rises above the upper envelope, then falls back below, sell. Example, EURJPY. In the chart below, notice how the 30 simple moving average, the orange line, and the upper and lower envelopes, the blue lines, are flat, almost horizontal even. Yep. So upper envelope acts as resistance, lower envelope acts as support, so the price just bounces between it. EURJPY is directionless here. There's no strong bullish trends, nor is there strong bearish trends. Observe how the upper envelope acts as a strong resistance level. Whenever price traded near the upper envelope, the price will fall back down. The same with the lower envelope. Observe how it acts as a strong support level. Whenever price traded near the lower envelope, the price will bounce back up. So buy signal. If the price touches or falls beneath the lower envelope, then rises back above buy, so that's just when it bounces back up. If prices touches or rises above the upper envelope and then falls back down, so won't like that, then sell. Okay, that makes sense. Summary. Moving average envelopes are used as a tool to confirm trend direction, but can also be used in sideways markets to identify overbought and oversold levels. I think this diagram would help explain a lot, to be honest. This one here. So let's do that. Actually, let's cut that. Do that. There we go. That's a good one. Okay, so I'm going to leave this episode here. In the next video, let me just save this real quick. We're going to be moving on to how to analyze trends with moving average ribbons. So thank you guys for watching this video, and I will see you next time. Peace.